Big changes are coming to superannuation, and the media is having an absolute field day with it. If you're a property investor and you're hearing the ATO and unrealized gains is making you feel a bit lost or worried, you're not alone. But before you jump into conclusions, let me show you what's really going on. My name is Eddie Dilleen, and I built a multi-million-dollar property portfolio worth over $100 million, and I've helped thousands of property investors navigate stuff just like this. In this video, I'll show you what the $3 million tax rule is all about, the people it'll actually impact, and what smart investors are doing right now instead of panicking. But let's start with what actually has changed. Here's the simple version. Labor has introduced to change the way superannuation is taxed. And if your balance of superannuation is over $3 million, the government is now going to tax above the earnings cap of 30% over. So instead of usually just 15%, it's now going to be 30%. And here's what's really been catching everyone's attention. This includes unrealized capital gains. So even if your superannuation's investments go up in value, but you don't even sell them, you can still get taxed on that growth. But this only applies to the portion above $3 million. So you can pay tax out of your superannuation and not out of your own pocket when it comes time to get taxed. Now let's talk about why most investors shouldn't even worry about this. 99% of people are not even close to having $3 million in super. And most people think that this tax is an actual attack on the average Australian out there. Here's an example. Right now, most people that go to retire have under $400,000 in super. It only kicks in once your superannuation balance is actually over $3 million. And that's the threshold isn't indexed. So unless you're growing aggressively or already absolutely killing it in life, this won't even apply to you. Here's some actionable advice. Focus on how to get to $3 million, not fear what happens when you do. And just a quick one, if you're serious about building your property portfolio big enough so that you can actually worry about getting taxed on over $3 million, grab my two best-selling books, 30 Properties Before 30 and How to Buy 10 Properties Fast. The link is in the bio description below. Let's say you actually get your superannuation balance to over $3 million, what actually gets taxed? Only the portion above $3 million that gets taxed at that tax rate. What most people get wrong is they think it applies to the whole superannuation balance of, let's say, $3 million. It doesn't, it's only above. Here's an example. If you've got $3.5 million in super, so that's just over 500K, you'll only get taxed the additional 15% on the 500K portion over $3 million, which only equates to about 75K. So it's not ideal, but it's not the end of the world. It's not 30% on everything. You still get the standard 15% rate on the first $3 million that you have in super. Only the earnings from the portions that are above the $3 million rate are hit with the extra tax. Actionable advice. Run the numbers. Do not let fear of headlines distract you from real wealth building. Still think this is unfair? Let's talk about the unrealized gains part. Unrealized capital gains sounds terrible, but it's manageable. What most people get wrong is they think they have to sell all their assets, all their properties, and go absolutely broke. Here's an example. If you have a self-managed super fund and it owns a property and that goes up by $200,000, even if you don't sell it, you could be taxed on the increase of capital gain. Yes, this is unusual, but you can pay that from your super fund. And if the value of the property drops later, you can get a tax credit back for the amount that it's dropped. Actionable advice. If you've got illiquid assets or a farm in your super, you should probably chat to your tax advisor or an accountant. Everyone else, you're pretty much fine. Why is this really being introduced? This is a targeted tax on the ultra wealthy. What most people get wrong is they think this is about everyday investors, and it's not. Only around 80,000 people in all of Australia are affected of this right now. And they're of course massive high net worth self-managed super fund holders. It's a revenue clawback strategy aimed at those who have already maximized the system. The government's not targeting you average Australian that ends up with less than 400,000 in super. Here's some actual advice. Use this as fuel. If you're ever affected by this rule, it's because you're doing something very, very right. And that leads to the real mindset shift investors need to make. If you're scared about paying tax, you're thinking too small. What most people get wrong is that they waste energy trying to avoid taxes they haven't even earned the right to pay yet. When I started with absolutely nothing, it wasn't about tax minimization. I was thinking about my next property deal and how I can actually make some money, not worrying about tax. Building wealth means that sometimes you're paying tax, and that's fine and it's normal. Tax is the cost of growth. The trick is to grow faster than you get taxed in the first place. Stop worrying about what happens when you get to $3 million mark in your superannuation and start doing what it takes to actually have a chance of getting there. So if this new proposed tax change has got you stressed, here's the real next move. This tax sounds absolutely wild on paper until you realize it only hits after you've absolutely killed it in life. And most of you haven't done that yet, so don't worry. But if you're still stuck trying to go from 1 to 5 investment properties, and that's the real roadblock of building your actual wealth, you need to check out this next video where I show you exactly how you can build a 5 property portfolio starting from with just 150K, and you can do it in under 2 years. Definitely go watch that now.